Stocks are up so far this year. If you don't already show a profit in your portfolio, should you buy or should you wait? After all, earnings for the fourth quarter and expectations notwithstanding Apple, they have not been too great. My guests are Ed Butowsky, managing partner at Chapwood Investment Management, where he helps oversee about $800 million worth of client money. And we have James Rickards. He is a senior managing director at Tangent Capital Partners. He is the author of the book Currency Wars, The Making of the Next Global Crisis. Ed Butowsky, let's talk about the economy right now and what this means for investors, because you've been getting some positive economic news for the United States on the jobs front, on the housing front, and on industrial production, inflation. Does this mean that people ought to go out and buy stocks now?
I'm very nervous. In fact, for the first time in probably the last 10 years, I've been very uncomfortable with what we see the economy looking like. And a lot of it has to do with growth from outside the U.S. Okay, yes, we had a liquidity crisis and so on, but stocks never really got expensive. Right now, we have to be focused on where earnings are coming in. And most of the earnings, about 50% of the earnings for the top 100 companies in the S&P, most of that growth comes from outside our borders. And there's really about four things that I'm concerned about. And the number one thing is Europe, okay? I mean, if Europe goes and starts to falter, we have major problems with our corporate earnings. And that's something everyone has to focus on. Obviously, rising commodity prices, rising interest rates, but I'm very uncomfortable. So if you're looking to buy stocks today, well, you don't have much of a choice because you can't sit in money market and lose purchasing power, but you can't shorten your time horizon either. So yes, I would be buying big dividend-paying companies and try to shy away from a lot of the companies that derive a lot of their growth from outside the U.S., which is hard to find.
All right, so avoid companies that are doing a lot of business outside the U.S. It sounds like you're getting a little defensive here.
I am getting, yeah, I am. I'm actually, have to tell you, I am defensive and I'm uncomfortable with this market.
All right, we're going to talk about utilities in a second. Jim,
okay.
What do you think? I mean, they're still negotiating some kind of debt plan in Europe over Greece. Yeah. As Ed was just describing, many of the companies reporting earnings, for example, DuPont today, missing sales estimates. So what do you think? People buy stocks, or should they just sit in money market funds or even buy the Treasury at 2.5%?
Yeah, Pimm, I'm more of a global macro guy than a stock picker, so rather than give you individual names, I will say I think it's a good environment for U.S. equities in 2012 overall, and I base that on a couple of things. Number one, the Fed's determined efforts to cheapen the dollar. When you're at the zero bound and you can't cut rates, you can still ease monetary conditions by cheapening the dollar. So I'm looking for, whether it's QE3 or nominal GDP targeting later this year, in the major
nominal is the important word, well, right? Nominal, because it's not real. You say it's nominal. It's just a number that's
nominal
increasing.
Is a fancy way of saying we don't care about inflation. Whether it's 2% real, 3% inflation, or 1% real, 4% inflation, the Fed doesn't care. They're going to target nominal GDP. Their theory is, hey, the debt's nominal. If we don't have nominal GDP growth, we're not going to be able to pay the debt. So don't worry about the inflation component. Just get the numbers up there. They'll do that by, see, the difference between that and QE3. With QE3, or sorry, QE2 or QE, they had a target as to amount and timing. QE2, they said we're going to do $600 billion intermediate-term treasuries before June 30th. Well, by March, the market was saying, well, what are you going to do at the end of June?
What else are you going to give me, right?
Exactly. The Fed doesn't want to be in that position. When you use a fancy word like nominal GDP targeting, there's no limit. There's no limit as to amount. There's no limit as to timing. The Fed's going to say, trust us. We're going to get GDP where it needs to go. And it could go on for years. And so that's basically a blank check for the Fed. But what that means is that free money, what's not to like about free money? The stock market loves it. So,
Ed Butowsky, what do you think? Free money from the Federal Reserve, maybe interest rates that stay low not just until 2013, but 2014.
Right. Well, they can control, as you know, Jim, they can control interest rates to a large extent on the short end, but the long end they don't. And it's really interesting we're talking about this because you're literally talking about how the Fed can do this and the Fed can do that. What about the free market? I mean, the free market is not, it's being controlled by
Jim
the
says
European Central Bank.
The free market loves free money.
Yeah, we don't. Well, I would say the stock market loves free money. I don't think we have free markets anymore.
No, we don't.
I think we have theater kind of orchestrated by the Fed. But they can do, variation operation twist, and with kind of unlimited QE, which is what notional GDP targeting is, they can affect the intermediate sector to some extent, not the same way they do at the short end. Right. And this is all designed to cheapen the dollar, which is a way of importing inflation from China.
All right, we're going to continue the conversation. You talk about cheapening the dollar. I want to find out your views on gold. It's up 6.5% so far this year. It rose 9% last year. Should you go ahead and buy some of the precious metal? We'll find out. All right, buy now or perhaps wait for a better price. And what about investing in gold? Let's find out from my guest. We have Ed Butowsky, managing managing partner, Chapwood Investment Management, helping to oversee $800 million worth of client assets. And Jim Rickards, he is a senior managing director at Tangent Capital Partners, the author of Currency Wars, the Making of the Next Global Crisis. Ed Butowsky, before we get to more on gold and, how to asset allocate, tell me about utilities. I was looking at Exelon today.
Right. Shares
of Exelon are down about 10% so far this year, right? The market's up about 4%, Exelon down about 10%.
Right.
And the dividend over 5%. Do you like utilities?
I love utilities. Last year, we were up about 21% in our utility sector, and it is very, very attractive. Remember, when 2008 occurred, all stocks went down, including utilities. It was very uncharacteristic about utilities. When money flowed back in, they didn't go into utilities. They're still extremely undervalued. I can't speak specifically to that stock, but the sector itself, you can pick up about a 4.5–5% dividend, and I think you'll have total return. My estimate is you'll see a 10–15% total return over the next 3 to 5 years each year in the utility sector. Everybody should own some utilities in their portfolio.
Why? Is that because you're worried that people are going to be taking on more risk if they don't buy utilities? Because utilities are always viewed as defensive stocks.
Well, they're defensive, but you get a double play. You get potential for income, potential for growth, and you also get this dividend. And I just think it's a brilliant play right now.
All right, potential for growth, but there is no dividend in gold, not for most companies. Jim, tell me about gold and what you think the relationship between gold and the idea that you're going to have increases maybe in nominal GDP, so they'll keep inflation, at least looking at the headline, constrained, but inflation will really go up.
Right, and we understand that's very bullish for gold. Here's the thing, Pimm. Gold's been up 11 years in a row. It's now the 12th year. It's up this year, so I would expect it to be up 12 years in a row. Normally, a trade like that would, by the way, stocks have been flat for 11 years. They've had a lot of volatility, but they're about where they were in 1999. You would expect that would be sort of a little bubbly or momentum-driven or trend-following, but in fact, portfolios have maybe 60% stocks, 40% bonds. Institutions as a whole, in the aggregate, have about 1.5% in gold.
Just 1.5%.
1.5%. If all they did was double that to 3, which is a tiny slice, there's not enough gold in the world at these prices to accommodate that. That would put gold well over $3,000 now. So I'm not predicting that, in the next few months, but that's just to give an indication that it's not a bubble. How can it be a bubble when you have 1.5% allocations? It's nowhere. It's heavily underinvested in that sense. And the kind of notional or nominal GDP targeting we were talking about is inflationary. Trashing your currency is inflationary, reports from abroad. That's also very good for gold. So
what about central banks buying gold?
Well, that's by the way, that's a reversal of a 10-year trend. From 1999 to 2009, central banks were net sellers of gold. There was even a cartel among the major economies agreeing that we're only going to sell 2,500 tons a year because we don't want to trash the market. Well, they haven't sold anything in the last 3 years. That agreement's still in place, but it's moot because central banks are now buyers of gold. Seen places like Vietnam who are buying gold. Obviously, China does it covertly. They use their intelligence and military services to buy it off market. The other thing China's doing, they're producing 300 tons a year. They've now become the largest gold producer in the world and moved from back.
And it stays in China.
It stays in China. Now, some of it goes on sale to the public because there's enormous public demand for gold. They have to satisfy that. They're also a huge gold importer just through commercial channels independent of the central bank. The central bank tends to buy their gold in secret and then announce these big pops every now and then. So they don't want to have a market impact to drive the price against them. But I see gold, over time at $7,000 an ounce, which we've talked about before.
Ed Butowsky, has Jim convinced you you're going to add a little gold to the portfolio?
I already have some gold, but there's an old line on Wall Street. You pay a dear, dear price for consensus. And what I fear is people over-allocate into gold, they over-allocate into Apple, and we all have to have balanced portfolios. Do I believe in gold? Absolutely. I believe in uranium, I believe in copper, I believe in anything you can put your hands on, quite frankly.
By the way, I recommend 10% for conservative investors, 20% for aggressive investors. I don't recommend going all in on gold, but the allocations are 1%.
Gentlemen, thank you very much. Jim Rickards, Ed Butowsky, appreciate your thoughts and your insights. All right.